Terrell, what does a market-neutral strategy in the commercial real estate market look like?
You know, it can mean a lot of things, but for us, we tend to focus on property segments that tend to be resilient in and out of cycles. And the way we ultimately got there was we looked at the underlying tenancy demand for these particular commercial property segments, and we were trying to find tenants that always had demand for that particular property type, whether GDP is +4 or down 4, whether interest rates are at 2% or 10%. That's kind of the idea. It's really about the resilience of the tenancy base.
All right, so you found student housing, senior housing, hospitals, that type of property tended to fit into that category. Am I missing anything?
Yeah, our three biggest buckets are healthcare, education, and what we call workforce housing, which is affordable housing for the middle income American.
So a lot of other firms, and I'm thinking even of, say, the Blackstones of the world, have gravitated toward these exact properties. And then you can throw in the warehouse properties as well with that. I'm wondering if that changes the equation, given the fact the valuations on these properties have gone up disproportionately in some cases.
Yeah, no, absolutely. We actually view it as a long-term positive for a few reasons. Number one, when the Blackstones of the world come in and the big sovereign wealth funds, you see liquidity increase precipitously. And so usually what happens is, particularly at large portfolio transactions, you see a pretty meaningful portfolio premium. Yet when you're buying more one-off and two-off, like we tend to do, you don't see quite as much of a premium on the buy side. So that's good when it comes to ultimately exiting. It also creates more validity or credibility for these particular categories. When we first started in these categories years ago, it was still considered niche real estate, and people were investing in them purely for better returns, not so much just because they have much more downside protection than traditional real estate. Now, because we're late cycle, so many new players are jumping in, to say the least, and have been for a number of years.
Have you been selling into the rally?
We absolutely have. And when you say rally, I guess we could say it's been about a 10 or 11-year rally. But we have been selling, particularly in large portfolio transactions. In fact, we've helped a couple of large sovereign wealth funds get into the senior living business and the student housing business. We've sold large portfolios to several of the largest private equity real estate fund managers out there. So it's been good for us, but ultimately it comes down to the individual property opportunity and where you could add value.
Are you deploying the cash that you raise from these sales, or are you hanging on to it for a potential downturn?
Well, it depends upon which of our investment vehicles it comes out of. Some of these are closed-end vehicles where once you sell the asset, you're distributing the capital back to the investor. Others are more long-life vehicles where, yes, we would recycle into assets that we believe might offer a better risk-adjusted return at that time.
What are the returns like in these market-neutral strategies?
This really has that, what a lot of people like to refer to as that asymmetric return profile. These asset classes perform well in good times, like we've had for the last 10 or 11 years. They've performed particularly well during the challenging times, like the global financial crisis or the tech wreck or the 91 to 93 recession. So it's a wonderful thing in that regard, where you get the benefits in both good times and bad times. The challenge with these property types is they do tend to have more nuance when it comes to investing in them. They tend to have more operational intensity. So despite the fact that you are more resilient to economic cycles and black and gray swan events, you do have to be very mindful and careful about when, where, and how you invest in these property types. They don't really work so well if you're kind of new to the space or you're more of a generalist investor.